When you study macroeconomics, there's this really comforting illusion that consumer spending acts like basic physics.
Oh, sure. Yeah.
Right? Like you apply a massive amount of pressure to something and it shrinks.
Yeah.
Like a very clean, logical assumption.
It is, yeah.
But if inflation is sticky, if geopolitical conflicts are shutting down major transit corridors and the cost to get on a commercial airplane is just skyrocketing because of capacity constraints.
Right.
The financial models all point in one direction.
Yeah.
They say, there it is. Discretionary spending is going to crater.
And well, for good reason, right? Yeah. Because historically, that binary logic holds up perfectly. You have less disposable income, you face more global uncertainty, so you delay the vacation, you stay home. Wall Street builds its entire risk assessment framework around that predictable behavioral physics.
But then you look at the actual data from the global travel sector right now, and suddenly you realize that spreadsheet is entirely broken.
Completely broken.
We are looking at a consumer landscape that is just completely defying gravity. The pressure's on, but the contraction just isn't happening the way the models predicted.
No, it's not.
So welcome to the deep dive. If you're trying to make sense of this behavioral anomaly today, whether you're mapping out an investment thesis or you just want to understand the quiet technological machinery running the global travel industry, you're in the right place.
Absolutely.
You're here with us as the crucial third member of this conversation, and we're unpacking what is arguably the highest definition X-ray of human movement available right now. We're looking at the Q2 2026 earnings call from Booking Holdings, Inc.
Which is really the perfect lens for this because, when the parent company of Booking.com, Priceline, and Agoda releases their quarterly data, they aren't just giving a corporate status update.
Right.
They process so much volume that their data acts as a real-time sentiment tracker for the global middle and upper middle class.
Oh, for sure.
If you want to know how people are reacting to geopolitical stress, you look at where they're willing to spend their discretionary income.
And that is exactly what we're going to tear apart today. We want to look past the standard Wall Street jargon to figure out how they managed to beat the odds this quarter.
Yeah, let's get into the numbers.
Because the headline numbers from their Q2 scorecard are, frankly, they're staggering.
Yeah.
Given the macro environment.
They really are.
Room nights. Yep. So that's the total number of accommodation nights booked across all their platforms. That grew by 5%.
Wow.
Gross bookings were up 9%, or 8% if we look at it on a constant currency basis. Revenue was up 8%.
Yeah.
And get this, their adjusted earnings per share shot up 15% to $2.54 per share.
When you look at that 15% EPS jump, you have to immediately ask, what is driving the underlying demand here?
Right.
Because the top line revenue growth is fighting against some massive headwinds.
Right. Well, let me bring some friction into this.
Go for it.
With the conflict in the Middle East severely disrupting major global transit corridors, and we're talking about airspace restrictions, massive rerouting for carriers.
Huge logistical nightmares, yeah.
Exactly.
Yeah.
And airfares going through the roof as a result of those capacity constraints. A travel giant, heavily reliant on international movement, should be taking a massive, undeniable hit to their top line.
You'd think so, yes.
It feels like travel is a rubber band that's just being stretched to its absolute breaking point by external forces.
Yet the human desire to explore seems to just violently snap it back into place.
It does.
Though if you dig into the commentary from their CEO, Glenn Fogel, and the CFO, you realize the demand didn't just passively survive, it shape-shifted.
What do you mean by shape-shifted?
Well, the demand for cross-continental, long-haul international travel did remain pressured, just as those physics models would predict.
Okay.
But people didn't decide to sit on their couches, they simply recalibrated their radius.
So they shifted their gaze closer to home.
Exactly. They pivoted entirely to domestic and interregional trips. The regional breakdowns they provided on the call are fascinating.
Break it down for us.
So Europe grew in the mid-single digits overall, but if you isolate domestic European room nights, they were up in the high single digits.
Oh, wow.
Right. And Asia grew mid-single digits, but domestic Asian room nights surged in the low double digits.
So people are still traveling, just inside their own borders.
Right. And the United States grew high single digits, and that was almost entirely driven by domestic demand.
So the psychology here is really resilient. I mean, if I'm planning to fly from New York to Tokyo and I see the airfare is astronomical or, I'm feeling uneasy about global tensions.
Which is fair.
My reaction isn't to cancel my vacation and put the money in a savings account. My reaction is to, rent a cabin in upstate New York, or maybe I take a shorter flight down to Florida.
Exactly. You still want the break.
Right. I'm still deploying that capital.
Yep.
I'm just deploying it within a different geographic footprint.
And that behavioral shift shows up in two very specific metrics that Wall Street absolutely obsesses over.
Which are?
The booking window and the length of stay.
Oh, right, which were both flashing warning signs early in the quarter.
Right, were, yeah.
The CFO noted a global contraction in both metrics. So people were waiting longer to book, shrinking that window, and they were cutting a day or two off their overall trip length.
Which is the ultimate indicator of consumer hesitation.
Totally.
If the macroeconomic environment feels unstable, you don't lock up $5,000 in non-refundable reservations 6 months in advance.
No way.
You hold your breath, you wait until 3 weeks before you want to travel, and maybe you book a 4-day weekend instead of a full 7-day excursion.
All right.
You hedge your bets.
But that hesitation didn't hold, did it?
No, it didn't.
Because the CFO explicitly pointed out that by June, both the booking window and the length of stay began to normalize globally. And in Europe, which is, that's their undisputed powerhouse region, both of those metrics actually flattened out entirely for the full quarter. The consumer exhaled and just went right back to booking their summer trips.
The normalization by June is the critical takeaway for anyone analyzing this space.
Yeah.
It suggests the initial shock of the Q1 and early Q2 headlines just kind of wore off. But there's a secondary question here.
Okay, what is it?
If the volume is shifting to shorter, closer to home trips, how is revenue still climbing at 8%?
That's a good point. You'd assume a weekend road trip generates significantly less revenue for booking than a 2-week European honeymoon.
You would, unless the company commands immense pricing power. And that is exactly what we see in their ADR, the average daily rate.
Ah, the ADR.
Right. Even when you strip out the noise of currency fluctuations, that constant currency metric they use, the actual price consumers paid for a room increased by 2% year over year.
Which means travelers aren't trading down.
Not at all.
They might be traveling closer to home, but they aren't compromising on the quality of the asset. They're still willing to pay a premium for a highly rated property.
Yep.
They're absorbing that 2% price hike on top of whatever localized inflation exists in that market.
And that growth in daily rates was primarily driven by Europe and the US. So you have a consumer base that is geographically flexible, but completely uncompromising on the existence and quality of the vacation itself.
Which brings us to the operational reality for a company like Booking Holdings. If demand is this resilient but constantly shape-shifting based on the news cycle, airline capacity, and inflation.
Yeah, it's a moving target.
How do you actually capture it? You can't just rely on them stumbling across your website when they finally decide where to go.
No, you can't.
You have to build an ecosystem so seamless and rewarding that the consumer never even considers leaving it.
You have to capture every single node of the journey, which is, it's the entire premise behind what they call the connected trip.
Let me throw an analogy at this to contextualize the scale of what they're attempting here.
Please do.
Historically, booking a vacation was like going to a bunch of separate independent boutiques scattered across town.
Right, a total headache.
Yeah, you go to one specialized agent for your flight, you walk down the street to a totally different vendor for your hotel, and maybe you track down a third kiosk for your rental car.
Exhausting just thinking about it.
Exactly. What Booking Holdings is trying to do with the connected trip is essentially demolishes those disconnected boutiques and build an enclosed, frictionless digital mega mall.
I love that analogy.
Right. Once you walk through their automatic sliding doors, you have zero reason to ever step back outside into the elements.
The mega mall analogy is spot on, but with one crucial addition.
Okay, what's that?
In this digital mall, the landlord is tracking exactly which stores you visit, how long you linger, and using that behavioral data to instantly discount your food court burger to ensure you stay for dinner.
Oh, wow. Yeah.
Because the traditional travel experience is incredibly fragmented. It requires multiple transactions and multiple customer service interactions.
So true.
If your flight gets delayed by 4 hours, the airline doesn't tell your hotel, and your rental car agency certainly doesn't know. You have to make 3 separate phone calls.
That's the worst.
The connected trip vision aims to link the underlying data so the entire itinerary breathes as a single entity.
And the data they presented suggests they're finally getting traction on this. The CEO noted that connected trip transactions, meaning, a traveler books more than one travel vertical for the same trip, that grew in the low double-digit range.
That's massive.
It is. Those multi-vertical transactions now represent over 10% of Booking.com's total volume. And that specific segment is growing meaningfully faster than their overall standalone room nights.
But, if we're looking closely at their execution here, we have to acknowledge a glaring weak spot in the strategy.
Well, there's always a catch.
An analyst actually brought this up during the Q&A, and it centers on the very top of the funnel, flights.
Right. Yeah, the analyst from Bank of America caught this. The connected trip relies on getting you into the mall, and usually the flight is the front door.
Exactly.
But flight ticket growth actually decelerated dramatically. The CFO admitted flight tickets only increased by 4% year over year.
Yeah, just 4%.
If flights are the quintessential starting point of a vacation, and that growth is slowing down to just 4%, it implies the foundation of this multi-vertical strategy might be cracking.
It's a genuine vulnerability, and the executives had to defend it carefully. They pointed back to the macro environment we discussed earlier.
Yeah, capacity issues.
Yeah, the global airline industry was severely constrained in Q2. You had massive capacity issues, aircraft delivery delays, higher ticket prices, and routes being completely redrawn due to airspace restrictions in the Middle East.
Yeah, Boeing's issues alone caused huge ripples.
Exactly. You can't sell a ticket on a flight that doesn't exist or that the middle class can no longer afford.
And to their credit, the CFO pointed out that the 4% unit growth actually outpaced the broader global airline market.
Which is saying something.
Right. So even in a constrained environment, they're stealing market share from direct airline bookings and other OTAs. But, and here's my question, the margin on a flight is notoriously razor thin. Why are they fighting so hard for a low margin product?
Because the flight is the behavioral hook.
Okay, unpack that.
The CFO was very transparent about their internal data. Travelers who book across multiple verticals return more frequently. They become sticky.
I see.
The airline ticket is essentially a loss leader. It gets the consumer to input their credit card, their travel dates, and their destination into the booking ecosystem.
You've got them in the door.
Once that data is captured, the platform immediately cross-sells the highly profitable accommodation booking. As the CFO reminded Wall Street, the vast majority of their economics still comes from accommodations.
It's the classic razor and blades model, just applied to global travel. Sell them the flight at a negligible margin to get them into the ecosystem, and then sell them the hotel, the rental car, and the attraction tickets, where the massive commissions are actually made.
Precisely.
But to make that cross-selling actually frictionless, you have to control the checkout process.
Yeah.
I mean, if I have to enter my credit card 5 different times for 5 different verticals, I'm going to abandon the cart.
Which brings us to the most critical, yet least glamorous, part of their entire operation.
Merchant payments.
Yes,
Yeah.
Merchant payments. This is the plumbing that allows the connected trip to exist at all.
And this represents a massive structural shift for them. The CFO mentioned that total merchant gross bookings reached about 73% of their total gross bookings. That's up 4 percentage points year over year.
It's a huge pivot.
For anyone not deeply entrenched in OTA unit economics, we really need to trace exactly how radical this shift is. Historically, Booking.com operated heavily on an agency model.
Yes. In the agency model, the OTA simply acts as a matchmaker. You go to Booking.com, you reserve a room in Paris, but no money changes hands online. You actually hand your physical credit card to the front desk clerk at the hotel when you arrive.
Like the old days.
Exactly. The hotel processes the payment, and then Booking sends the hotel an invoice for their 15 or 20% commission at the end of the month.
Which is incredibly fragmented.
Yeah.
The platform doesn't actually control the money. And if they don't control the money, they can't bundle a flight, a hotel, and a rental car into one single seamless checkout cart.
No, they can't.
If I'm paying the airline today, the hotel next month, and the rental car counter on Tuesday, the connected trip is just a marketing buzzword.
Exactly. By shifting to a merchant model, Booking processes the traveler's payment directly on their own platform at the moment of booking.
They become the merchant of record.
Yes. They take your $2,000, they hold it, and they disperse the funds to the various travel providers on the back end.
And from a purely financial perspective, the float on that cash is massive.
Oh, it's unbelievable.
If I book a $2,000 trip in March for vacation in July, Booking Holdings gets to hold my cash for 4 months before they have to pay the hotel.
Yep.
In an environment with 5% interest rates, the working capital benefits of the merchant model are just astronomical.
It creates a massive balance sheet advantage, absolutely. But, more importantly for the consumer, it eliminates friction.
Right.
The CFO called their merchant payments platform foundational because it generates incremental value by allowing them to offer customized, bundled pricing that the agency model physically cannot support.
And all of this transactional data feeds directly into their other massive moat, right?
Yeah.
The Genius Loyalty Program.
Oh, the Genius program. The metrics there are wild.
They really are.
The CEO mentioned that level 2 and level 3 Genius members, so their most elite, frequent travelers, they make up just over 30% of their active accounts.
Okay, 30%.
But that 30% of accounts is responsible for a staggering 50% of all room nights booked globally.
Wow. It's the ultimate manifestation of the Pareto principle.
It really is.
Your top-tier power users are driving a vastly disproportionate amount of your volume. And if you look at the behavioral traits of a level 3 Genius member, they are exactly what you want in a volatile macro environment.
Oh, 100%.
The CEO noted they plan trips further in advance, they return more consistently, and most importantly, they have a significantly higher direct booking rate.
Meaning they bypass the traditional internet entirely.
Right.
They don't go to Google and search hotels in Miami. They just unlock their phone, open the booking app, and trust that their Genius discount is going to give them the best rate.
It creates a self-sustaining loop.
It does.
You pull them in with a cheap flight, they book the hotel through your merchant payment system, they hit Genius Level 2, they get a 15% discount on their next trip, so they come straight back to the app.
But a digital loop is only as strong as the physical inventory it connects to.
That's a great point.
You can have the most frictionless payment system in the world, but if you don't have the right properties in the specific cities your consumers want to visit, they will abandon the app and go to a competitor.
Which means we need to look at the ground war.
Yes, the supply side.
They have to dominate the physical supply of travel. And the executives made it very clear on this call that they are hyper-focused on two massive geographic arenas right now, Asia and the United States.
Right. Asia is deeply complex because it is highly fragmented, but they have Agoda, which is culturally and technologically entrenched in the Asian market.
Right, they've got a strong foothold there.
But the U.S., however, is their white whale.
Totally.
Booking dominates Europe, but the U.S. has historically been a much tougher market for them to crack against entrenched domestic competitors like Expedia.
They've been pouring capital into U.S. brand marketing and supply acquisition for years, and it seems to be yielding results. U.S. room nights grew in the high single digits, entirely supported by domestic demand.
Yeah, that's solid growth.
They also noted another quarter of direct channel growth. But if we're looking for cracks in the foundation, the U.S. market is where we find a very specific structural vulnerability.
You're pointing to the alternative accommodation sector.
Exactly.
Yeah.
The short-term rentals, the mountain cabins, the beach houses, basically the Airbnb and VRBO territory.
Right.
During the call, the CFO admitted that alternative accommodation room nights globally only grew 4%. That trails their overall 5% room night growth. And he explicitly blamed this on the U.S. market. Their alternative accommodation offering is relatively small in the U.S. compared to their massive global footprint.
It is a remarkable admission of weakness, honestly.
It really is.
Globally, alternative accommodations represent about 37% of Booking.com's room nights. That is a massive slice of the pie, right on par with their pre-pandemic Q2 2019 levels. But in the U.S., they're lagging significantly behind the market leaders. The CEO sounded almost frustrated during the Q&A, acknowledging that he sounds like a broken record about needing the right inventory and making sure the U.S. customer is actually aware they offer homes and apartments, not just traditional hotels.
It's the ultimate chicken and egg supply problem.
Completely.
I mean, if you want a family in Ohio to book their Florida beach house on Booking.com, you need to have a massive inventory of beach houses to show them.
Right.
But to convince property managers and individual owners to list their beach houses on your platform, you need to prove you have the domestic traveler volume to generate bookings. Airbnb has the mind share in the U.S. overcoming that requires grinding it out property by property.
It is a street fight for supply.
Yeah.
But while they're fighting that physical ground war in the U.S., they are simultaneously fighting an existential digital war in the cloud.
Ooh, yes. Let's get into this.
And this brings us to what I consider the most fascinating subtext of the entire earnings call. The CFO casually dropped a phrase that should terrify any company reliant on digital marketing.
What did he say?
He mentioned the continued pressure on SEO.
Search engine optimization. For the listener not steeped in digital marketing, SEO is the art of getting your website to show up for free at the top of a Google search when someone types in best hotels in Rome.
Exactly.
For the last 20 years, the entire OTA business model relied on mastering Google's algorithm. Why is that suddenly under pressure?
Because the architecture of the internet is fundamentally shifting.
Right.
An analyst from Mizuho pressed them on this exact point, asking if the pressure was due to a shift to AI search or just a general decline in organic visibility.
And what did the CEO say?
Well, Glenn Fogel didn't parse words. He explicitly pointed the finger at the changes Google is making to its search displays, specifically the new AI overviews that Google is injecting at the very top of the results page.
Right. If you search for travel information now, Google's AI just reads the answer to you?
Yep. It doesn't give you a list of 10 blue links to click on anymore. It hoovers up the data from travel blogs, Wikipedia, and OTAs, and presents a synthesized answer directly on Google.com.
It's a closed loop.
Yeah. If the user gets their answer without ever clicking a link, the free organic traffic to those websites instantly dries up. Google is cannibalizing the traffic to keep the user on their own real estate.
Which is an existential threat to any business that relies on top-of-funnel search discovery.
Huge threat.
But this is where we see the absolute brilliance of Booking's long-term defensive strategy. They saw this coming years ago.
How so?
When the CFO mentioned the SEO pressure, he immediately contextualized it by stating that SEO remains a very small component of their overall room nights.
Wait, if Google is choking off the free traffic, how is Booking still growing at 8%?
Because they've spent the last decade building a fortress that bypasses Google entirely.
Ah, I see. The CFO revealed two critical data points that prove this. First, their direct-to-consumer mix remained incredibly stable in the mid-60% range over the past 4 quarters.
Okay.
And secondly, the mobile app mix of total room nights remained in the high 50% range.
We really need to pause and absorb the scale of that.
It's huge.
More than half of all their hotel bookings, we're talking about millions upon millions of room nights globally, are happening because a consumer physically unlocked their smartphone, intentionally ignored their Safari or Chrome browser, tapped the Booking.com app icon, and executed a transaction.
Wow.
That is an astonishing level of brand power.
It's the ultimate defense mechanism against big tech algorithms.
It really is.
The CEO noted the trajectory, right? A year ago, the app mix was in the mid-50s. 2 years ago, it was in the low 50s. They are actively training consumers to alter their fundamental digital behavior.
Wow.
If you have the app installed and you're a Genius member knowing you get a 10 or 15% discount by booking directly, you have zero incentive to go search on Google.
None at all.
You go straight to the source. They've insulated themselves from the whims of Google's AI overviews by owning the most valuable real estate in the world, the home screen on your phone.
But, owning the app is only half the battle.
True.
If you force tens of millions of people into your proprietary app, you now have to manage the customer service for all of them.
Oh, yeah.
And travel is inherently messy. Flights get canceled due to weather, hotels accidentally overbook, travelers show up, and the room smells like smoke.
It happens all the time.
You have to manage millions of furious, panicked travelers demanding instant support. Historically, scaling customer service means your operational costs spiral out of control, eating all your profit margins.
Which brings us to the operational core of this deep dive. How they're leveraging artificial intelligence to solve that exact scaling problem.
Finally.
And to be clear, we need to separate this from the typical Silicon Valley hype.
Thank you. Because as a consumer, and certainly as someone analyzing the tech sector, I am experiencing severe AI fatigue.
I think we all are.
Right. Every single company, from dog food manufacturers to shoe retailers, claims they are leveraging AI to revolutionize their business. Usually it just means they slapped a terrible, unhelpful chatbot onto their homepage.
Yeah, a chatbot that just links you to the FAQ page.
Exactly. But when I read through this transcript, I was stunned. The executives didn't just offer buzzwords, they brought receipts.
They really did. They provided tangible, measurable business outcomes driven by their AI implementation.
And what were the numbers?
The most staggering data point in the entire call wasn't about top-line revenue. It was about internal cost reduction. The CEO revealed that thanks to scaled voice AI and digital automation, their customer service cost per booking is decreasing at a double-digit rate.
A double-digit decrease in customer service costs.
Yep.
In an era of rampant global wage inflation. Let's think about the traditional trade-off here. Usually, if a massive corporation slashes customer support costs by 10 or 15%, they do it by outsourcing to a cheaper, less effective call center. Wait times explode, problems go unresolved, and customer satisfaction just plummets.
That's the historical rule of thumb, right? Cost and quality in customer service are inversely correlated. But the CEO explicitly stated that while costs are falling at a double-digit rate, their overall customer satisfaction, or CSAT, remains remarkably high.
How is that mechanically possible? This clearly isn't just a clunky chatbot that makes you scream "representative" into your phone and press 0 12 times.
No, definitely not.
It sounds like they've deployed an army of hyper-efficient digital concierges that never sleep, saving the company millions of dollars in operational overhead.
It works because they aren't treating AI as a complete replacement for human agents. They're using it for symbiotic augmentation.
Augmentation. Okay, explain that.
The CEO detailed how they've scaled voice AI support across the majority of eligible inbound traveler calls. The AI handles the high-volume, low-complexity requests instantly. If a traveler calls and asks, "What time is check-in?" or "Can I cancel my reservation without a penalty?" the AI resolves it in seconds without ever touching a human agent.
Which clears the queue.
Precisely. But more importantly, when a call is complex, say a family is stranded at an airport at 2 a.m. because a flight was canceled, the AI instantly routes that call to a human. But it also acts as a real-time agent assistant.
Oh, that's brilliant. So the human agent doesn't have to spend the first 5 minutes of the call clicking through 4 different legacy software systems, asking for the booking reference number, and trying to figure out what happened.
Right.
The AI instantly pops the entire context onto the agent's screen, summarizes the problem, and suggests 3 actionable solutions.
Exactly. It drastically reduces the average handle time of complex calls, which drives down costs, while actually improving the experience for the panicked traveler, which keeps CS high.
That's a win-win.
But if you think about the underlying infrastructure required to do this, it raises a massive financial question.
Right. Running these massive language models is computationally expensive. Every time an AI processes speech, analyzes text, and queries a database, it burns server compute.
Exactly.
If you're using AI for millions of daily customer interactions, isn't that a massive, spiraling cost drain on the IT budget?
An analyst from UBS actually asked that exact question, trying to model out their future tech margins. And the CFO's answer was a masterclass in enterprise technology management.
What did he say?
He introduced a framework that every tech executive should be studying right now. He called it cost-aware model routing.
Cost-aware model routing. Okay, for the listener who hasn't built an enterprise AI stack, what does that actually mean under the hood?
It means they recognize that not all AI tasks require a genius-level intellect. To use an analogy, you don't hire a neurosurgeon to put a Band-Aid on a paper cut.
Okay, fair enough.
The CFO explained that every time an AI prompt is generated within their system, a middleware layer acts as a traffic cop. It analyzes the complexity of the request before sending it to a model.
Ah, I see. So if a customer is just asking to reset their password, the traffic cop routes that to a cheap, highly efficient, lower parameter open source model. It costs fractions of a penny to execute.
Exactly.
But if an internal developer is asking the AI to review a complex string of code for a new payment gateway, the system routes that to the expensive, high-powered frontier model like OpenAI's GPT-4.
That is exactly how it functions.
Right.
By dynamically routing the requests based on complexity, they control the token costs.
Right.
And the CFO noted that because of this discipline, their total AI costs are still a very low single-digit percentage of their overall technology spend. They're getting massive operational leverage without blowing up their cloud budget.
And the CFO stated unequivocally that they're already seeing a net positive ROI on their AI investments today.
Yes, he did.
He specifically called out developer productivity. They measure something called merge requests, which is essentially how fast their software engineers can write, test, and deploy new code into the platform. Yeah. AI is accelerating that process, making their internal teams dramatically faster. It's not just an R&D experiment burning cash. It's a functioning engine of operational efficiency.
So they've clearly mastered the internal back-end AI implementation, but to drive future top-line revenue, AI has to change the front-end experience.
Yeah, what does the traveler actually see and interact with?
They detailed several consumer-facing AI initiatives across their portfolio, and it's clear they're throwing a lot of darts at the board to see what sticks.
Like what?
Well, for Booking.com, they're rolling out an AI-powered discovery experience. This is aimed entirely at the inspiration phase.
Okay.
Historically, you went to Booking when you already knew you were going to Paris next Tuesday. Now, if you just search a vague concept like warm destinations in October, it synthesizes flight prices, pulls themes from real verified guest reviews, and offers AI-generated itinerary suggestions.
Well, that's cool. It's trying to bridge the gap between dreaming about a trip on social media and actually executing the transaction.
Exactly. And then you look at Priceline, which has launched the next generation of its agentic AI travel assistant named Penny.
The agentic part is key here.
Yes.
The CEO noted they're in the initial testing phase of integrating the hotel checkout experience directly into Penny. The holy grail here is a single, seamless conversational interface.
It would change everything.
Right. You open the chat, you tell Penny, I want a hotel in Miami next weekend under $300 a night. It needs a pool and it has to be pet friendly.
Yeah.
She finds it and you literally just type book it. And she uses your stored credentials to execute the payment without you ever leaving the chat window or clicking through multiple screens.
It is the ultimate reduction of friction. And then Agoda is approaching it from a visual angle. They launched a feature, the transcript transcribed as cattle review.
Yeah, saw that in the source text.
Yeah.
Unless Agoda is suddenly pivoting hard into agricultural tourism and farm stays, I am going to assume the AI transcription bot hallucinated and meant catalog review or maybe gallery view.
Let's assume it meant catalog review.
Yeah.
The functionality they described is actually quite clever. Instead of forcing a user to read a massive wall of text to figure out if a hotel is good, the AI dynamically pairs specific guest sentiments with the relevant property photos.
No, that's smart.
Right. If a review raves about the infinity pool, the AI overlays that text directly onto the picture of the pool. It turns text-based research into a highly engaging visual browsing experience tailored for a mobile screen.
But, despite all these front-end innovations, we have to pause for a reality check here.
Let's do it.
We talked earlier about Google's AI overviews and the threat of large language models changing search behavior. If I can just pull up ChatGPT or Claude and ask them to plan my entire vacation, isn't Booking terrified that these foundation models will become the new OTAs and steal their business entirely?
This was perhaps the most grounding, pragmatic moment of the entire earnings call. The CFO addressed this existential fear head-on. He revealed that if you look at the actual traffic they are currently receiving from large language models, including both paid advertising links within the LLMs and unpaid organic referrals, it is still significantly below 1% of their total room nights.
Below 1%.
Yeah.
So you have endless panic in the financial media about ChatGPT destroying the legacy travel agencies. And the reality is that it's driving a microscopic fraction of their actual business.
Exactly.
And the CFO noted this number hasn't moved materially over the last few quarters. Why is that? Why aren't consumers migrating their transaction behavior to the LLMs?
Because of the psychology of a high-value transaction. The CEO offered a very insightful perspective on this.
What was his take?
He argued that as travelers increasingly begin their journeys through generative AI experiences, trusted brands will play an even more important role in where they ultimately choose to book.
That tracks perfectly with human behavior. I mean, think about it. I might absolutely use ChatGPT to brainstorm an itinerary for a 10-day road trip through Tuscany. It's fantastic for spitting out ideas for obscure towns to visit or suggesting a route.
Oh, for sure.
But when it actually comes time to hand over $3,000 for a villa, am I going to trust a generic AI chatbot to process my credit card, guarantee the reservation, and handle the refund if the owner cancels on me?
Absolutely not.
No. I want the security, the customer service guarantee, and the verified payment infrastructure of a brand I know and trust, like Booking.com.
The inspiration and discovery phase might shift toward the LLMs, but the transaction phase requires trust and operational certainty.
Exactly.
And Booking is actively working to make sure they capture the user in both phases. The CFO mentioned they are part of OpenAI's test group for paid advertising.
Oh, interesting.
Yeah, so if a user does ask ChatGPT for a hotel recommendation, Booking is paying to ensure their highly optimized direct booking links appear seamlessly in the AI's response.
But ultimately, their strategic focus is on keeping the direct traffic within their own app ecosystem, using AI as an internal operational superpower to slash costs and boost efficiency, rather than waiting for an LLM to become a massive new customer acquisition channel.
Which is a perfect segue into the final layer of this analysis.
Let's hit it.
Because while AI is streamlining the software, the executives are also physically restructuring their business units to squeeze out every single ounce of operational efficiency.
Right, let's talk about the back-end plumbing. We spent this entire time talking about the consumer, the person booking the vacation. But Booking Holdings has a massive shadow empire on the business-to-business or B2B side.
They do, yeah.
They supply hotel inventory to other massive corporations. If you book a hotel through your credit card rewards portal or through your corporate travel management system, there's a very high chance the underlying inventory is actually being supplied by Booking Holdings on the back end.
Yes. But historically, this was managed incredibly inefficiently. Agoda, Priceline, and Booking.com all operated their own separate siloed B2B units.
Sounds messy.
It was. You essentially had 3 different sales teams from the same parent company pitching the exact same corporate clients using different technology platforms.
Wow. But the CEO announced they're finally ending that fragmentation. They're merging all of these disparate operations into a single, unified B2B platform led by the CEO of Agoda, whom Fogel praised heavily.
Yes.
The goal is to walk into a major U.S. bank or a global airline with one unified, dominant, best-in-class inventory system.
But if you look at the unit economics of B2B, it raises a major strategic dilemma.
Okay, what is it?
An analyst from Wells Fargo essentially asked the million-dollar question. If you're Booking Holdings and your core business is selling directly to the consumer at a massive high margin, why do you want to sell your hotel inventory wholesale to a corporate travel portal? Aren't you just cannibalizing your own direct consumer sales and letting a third party take a cut of your profit?
It's a huge risk. If I usually book on the Booking app, but I suddenly realize I can book the same room through my airline's portal and earn frequent flyer miles, Booking just lost a high-margin direct customer and gained a lower-margin wholesale customer.
And that is the exact tightrope the CFO addressed. His response was sharp and revealing.
What did he say?
He stressed the absolute necessity of rigorous data tracking and focusing entirely on incrementality.
Incrementality, the holy grail of enterprise strategy.
Exactly. It means they mandate that any B2B deal must bring in new volume customers that the Booking platform would not have reached organically.
That makes sense.
The CFO admitted that it's very easy to grow a B2B business rapidly if you don't care about cannibalizing your B2C channels. You just undercut your own prices.
Right, but they won't do that.
No, they refuse to do that. They are meticulously measuring the data flows to ensure that every wholesale partnership provides a purely additive boost to the bottom line, fiercely protecting their high-margin direct business.
It's a level of ruthless operational discipline that extends beyond just their sales strategy. It's hard-coded into their entire financial operation. They're obsessed with wringing efficiency out of the corporate structure.
Which brings us to the financial transformation program. Amidst all the talk of AI and connected trips, the CFO quietly announced that they've identified an additional $100 million in expected annual run rate savings.
Wow.
This brings their total expected annual savings from this specific program to roughly $650 million by 2027.
$650 million in savings. That is a staggering amount of capital just found in the couch cushions of corporate bloat.
It really is.
But where is that extra $100 million coming from? Are they initiating mass layoffs?
Not primarily. The CFO noted that this new tranche of savings came mostly from their procurement work stream.
Procurement?
Yeah, they simply got better at negotiating enterprise contracts, consolidating their global vendors, and managing how they buy the massive amount of goods, services, and cloud computing required to run a global tech monopoly.
Just operating smarter.
Exactly. They went deeper into existing categories of operational savings rather than cutting new areas of headcount.
And the strategic question is, what do you do with all those savings?
Right.
The CFO made the capital allocation strategy very clear. It creates the capacity to self-fund their future. They take the $650 million they saved on procurement and legacy IT, and they pour it straight back into building the connected trip.
Yep.
They use it to fund the expensive AI development we talked about, and they finance that ground war for supply in the U.S. It's a financial engine that completely funds its own innovation without needing to take on expensive debt.
And that operational engine generates an almost unfathomable amount of cash. To truly understand the power of this company, you have to look at their liquidity.
The free cash flow.
Yes. During this single, supposedly macro-pressured quarter, they generated a massive $3.6 billion in free cash flow.
$3.6 billion in pure, unencumbered cash, just sitting in the vault after all the bills, taxes, and operational expenses are paid.
It's absurd.
That is a jaw-dropping number for a 90-day period.
Yeah.
And what did they do with it?
They rewarded their investors. They returned $4.1 billion to shareholders in the quarter, which included a massive $3.7 billion spent entirely on stock repurchases.
Wow.
The CFO proudly noted this marked another record quarter of capital returns. In just the first half of 2026, they've repurchased $7.4 billion of their own common stock at an average price of about $173 per share.
For anyone holding the stock, that is a massive mechanical tailwind for the earnings per share.
Absolutely.
When a company buys back that much stock, they essentially retire those shares, reducing the overall number of shares in existence. That makes every remaining share represent a slightly larger piece of the company, instantly making it more valuable.
Yeah, it artificially boosts the EPS.
It's a flex of absolute, undeniable financial muscle. They're essentially telling the market, we have so much cash and our business model is so resilient that the best investment we can make right now is just buying ourselves.
It is the ultimate expression of corporate confidence.
It is.
They're investing heavily in speculative future technology, defending their market share in highly competitive geographies, navigating a volatile global economy, and they still have enough cash left over to execute a multi-billion-dollar buyback program without breaking a sweat. It demonstrates a deeply ingrained, highly disciplined capital allocation framework that Wall Street adores.
So as we start to pull all these complex threads together, what is the grand narrative here?
Yeah, let's summarize.
We've covered the macro elasticity of travel, the mechanics of merchant payments, the SEO squeeze, the realities of AI cost routing, and massive stock buybacks. If you had to distill this entire deep dive down for someone trying to understand the future of the travel industry, what is the core thesis?
I think the most crucial insight is that Booking Holdings is navigating an incredibly volatile world by actively refusing to play a passive role in the ecosystem.
Okay, say more about that.
They aren't sitting back, managing their hotel listings and hoping Google sends them cheap clicks. They recognize that era is over.
Done.
They're actively building an enclosed, friction-free digital megamall. They're using their Genius loyalty program and their massive merchant payments infrastructure to trap the value.
Right.
They lock the customer in with a flight, reward them for booking a hotel, process the payment seamlessly, and simultaneously use AI as a scalpel to slash internal operational costs and boost margins, even when global macro growth slows down.
If I can synthesize that overarching theme, it feels like we're witnessing a fundamental transition in the philosophy of travel tech.
Yeah, I agree.
For the last 20 years, the travel industry was entirely defined by search and discovery. Who has the best search engine? Who can aggregate the most blue links on a page? But this earnings call suggests we've entirely moved past that phase.
We have.
We're now entering an era defined by loyalty and seamless execution. The winner isn't the platform that helps you find a hotel. The winner is the platform that can manage the complex logistics of your entire trip so flawlessly that you never even think about opening a new tab to look somewhere else.
That is exactly the transition. The competitive moat is no longer just having the most digital listings. It's having the deepest, most integrated transactional relationship with the traveler.
Which leaves me with a final, slightly provocative thought for you, our listener, to mull over on your own time.
Oh, I love these.
We spent a lot of time today talking about how AI is currently an internal operational tool for them, and that LLMs only drive a tiny fraction of direct bookings right now because consumers don't trust them with their credit cards yet.
Right.
But let's project 5, maybe 10 years into the future. If artificial intelligence eventually becomes perfectly agentic, meaning your personal AI assistant running on your phone can reliably plan, negotiate, book, and troubleshoot your entire 3-week European vacation with absolutely zero friction, seamlessly interfacing with every vendor's API behind the scenes, will the value of a massive travel brand shift entirely away from the technology of the booking process?
That is a fascinating systemic question. If the personal AI handles all the friction of discovery and payment.
Right. If everyone has a super smart AI that can scour the web and execute secure bookings instantly, the digital interface itself is no longer the moat. The app doesn't matter anymore.
Wow, yeah.
If that happens, does the true value of a company like Booking Holdings revert entirely back to who holds the physical keys? Will the battle simply be about who has the exclusive proprietary contracts with the best independent hoteliers in the world?
Because the tech is democratized.
Exactly. If the digital tech is completely democratized by AI, maybe the messy, real-world relationships with millions of property owners become the only defensible asset left.
A shift from digital aggregation right back to physical exclusivity.
Yeah.
It's a compelling thesis, and honestly, it highlights why their ground war for supply in places like the US is so critical to their long-term survival.
It's definitely something to think about the next time you open an app to book a weekend getaway, or the next time you look at the murky, unpredictable data of the global economy. The structures holding it all together are adapting faster than we realize, quietly rewriting the rules of consumer behavior.
Very well said.
Thank you so much for joining us on this deep dive. Stay curious, keep questioning the underlying mechanics, and we will see you next time.